All right, let's get started. Good afternoon, everyone. Welcome to our webinar, and we thank everyone for joining. Today, we're going to share how utilizing Tableau with advanced analytics can help supermarkets and grocery stores utilize Tableau to positively impact their business. We'll look at specific use cases that improve the accuracy of demand planning, fine-tune supply chain networks, and better inform pricing and promotion decisions. Today's session will be recorded, and that recording will be distributed via email for those who can't make it or would like to rewatch. Also, there will be time for Q&A, so please chat your questions in the chat box, and we will address these at the end of the presentation. A real quick context on who is speaking. So my name is Joe Niewiadomski, and I head up our partnership with Tableau on the East Coast. I'm also joined by Raz Nister, who leads our data science and retail and consumer good practice here at Curis. So who is Curis? Curis is a global data and analytics consultancy and an esteemed Tableau partner. We have a few thousand data experts worldwide across many continents and countries. And everywhere we operate, we exist to help our clients get the most value out of their data. We have local offices in New York, DC, LA, and Toronto. And notably, retail and consumer goods is one of our largest components of our practice. And we've worked with several of the largest grocers and supermarkets in the US and abroad. We help folks such as yourselves generate value from their data assets by first helping them build a roadmap to get where they are now to where they could be if they best utilize their data assets to make decisions. Then our technical team carries out the implementation of that roadmap, including pieces such as data consolidation, data visualization in Tableau, or advanced analytics projects, and turn our clients' data into actionable insights that improve and positively impact their business. And now I'd like to introduce Raz, who is going to run through the meat of the presentation. And take it away, Raz.
Great, thank you so much, Joe. Welcome, everyone. Thank you for joining us this afternoon. Hope everyone is safe and continues to, survive and thrive, hopefully, in the lockdown environment that we find ourselves in. As Curis, we help companies sort of try to get the most value from their data, as Joe mentioned. And, typically, just at a high level, we ideally would love to implement, like an end-to-end sort of roadmap for companies going from like raw Excel hell type data all the way up to like becoming a AI-driven enterprise. And typically this process, like traditionally maybe 2 years ago, would have looked pretty linear like this, like one piece follows another. You got to get data, got to put it in a data warehouse and clean it and make some reports off it, and then maybe drive some engaging BI and Tableau solutions with interactive visuals, then maybe do some of the advanced modelings. But if there's a theme that we've really been feeling in the last little while, it's that executives, managers, and organizations in general have been pushing to get greater insights and returns from their investments in analytics earlier in the process than what was happening about 2 years ago. And sort of tactical AI or AI-driven analysis, insights, and optimization has really come to the forefront. So we see more and more sort of integration with advanced analytics starting much earlier in a sort of data analytics journey than we have today. We're going to sort of go through a bit of a story, an end-to-end story, and some use cases specifically in grocery. But I think there's themes that can mirror other sub-industries in the retail and CPG space. And we're going to see how leveraging some advanced analytics could help us not just get insights from the data, like in a traditional reporting sense, maybe as operational reporting used to do, but to really help us inform decisions using, say, for example, what if analysis, using optimization to help us find the prescriptive path forward from our data, and to try to understand not only what is our data telling us, but what is it telling us that we should do? Where are the gaps, and how should we fill those gaps essentially? And we're going to go through a few use cases in grocery specifically. I think it's a very exciting channel, has tons of data. Everyone shops at grocery stores, obviously, and there's a very rich data and analytics environment in a lot of the customers that we work with in the space. And to really understand where these use cases come from, we sort of have to understand the value chain of grocery, in that they essentially purchase, products and goods and produce and meat and everything that we see and sell in grocery stores from vendors, manufacturers, and producers and farms. We have to ship those products. Typically, they go to a distribution point. Sometimes that's owned by the grocery chain or the parent company itself. Sometimes in its external warehouse, depends on the product and vendor. Then it goes usually into the retail stores and makes its way to the consumers eventually. And as we sort of go through this value chain, there's always a component of sales that gets essentially marked up due to increasing costs, shipments, and operational sort of investments that have to be made. So there's this kind of markup that happens along the chain, really driven by essentially getting the product out to the consumer. And what we see is some very interesting conversations essentially that get formulated along this value chain, in that because there's all these sort of moving costs of goods and analyses and trying to push certain products out and to promote certain programs and campaigns to the customer so that they could buy more specific product. We see there's all kinds of sort of conversations, deal levels, different types of promotions, investments, advertising, and campaign incentives that are done to sort of help move product out the door quickly, sort of offer better deals and incentives to consumers to buy certain products. And a lot of these are, kind of exist throughout the value chain or supply chain here. But some of the names that we come across in this sort of value chain are things like lump sum funding that we get from vendors. So for example, if I'm a yogurt company, we work with some yogurt companies here in New York State. If I'm a yogurt company and I want to promote certain SKUs or new products, I have to incentivize my retailers to sort of push those out and promote those. I may give them a lump sum funding. I may give them some item level funding. I may support EDLP in certain big box grocery chains, which is everyday low price. So having perma sales essentially on products. I could support temporary price reductions or TPR on products, basically things that go on sale. I like to do features and, oh geez, keep switching the slides. I like to do features and displays and have things in advertisements and the penny saver coupon ads that come through. And I could do a lot of things to sort of incentivize sales, but there's a lot that goes underneath the hood in order to keep this entire chain functioning, to keep it happy and healthy. And some of the use cases that we see along these sort of value chains are a lot in process optimization, what we call things like demand planning, better forecasting, supply chain optimization, understanding what if scenarios if the supply chain gets disrupted, like we'll see here today. A ton of work in consumer insights to understand who the customer is. A lot of grocery chains have loyalty programs now that allows us to sort of understand exactly who the guest or the customer is shopping at our stores. And a very common theme in a lot of our work across CPG and retail is essentially ROI type of studies and analyses, particularly around some of those promotional activities that we could do in supporting EDLP versus sampling versus sort of feature and displays versus sort of more tactical price reductions that we can do, and understanding where the inflection points is or where the inflection points are in our sort of activities and campaigns that we do, so that we don't undercut ourselves and sell things at a far reduced price point that affects our margins. And that's kind of a common theme, not just in grocery, but in many CPG and retail sort of industries. Okay, sorry about that, 1 second. So now we'd like to get into some examples of these use cases and how we realize and visualize these in Tableau, okay? So we're gonna go through a little story. We're gonna start with some operational reporting and see how it informs some demand planning processes, or at least like some foundational elements of demand planning processes. You can see we're starting to favor like dark themes here on our dashboards. We're going to go to an app that sort of optimizes our supply chain and does a little what if analysis that I think would be relevant in today's time as a sort of distribution networks get disrupted due to the lockdowns. And if all things are good and healthy and we're getting product into the stores and onto the shelf, then we want to wrap things up with making sure that we're selling at the right price points, doing promotional analytics so that we can really try to optimize our profit margins. Not so much worry about our revenues, but essentially make sure that we're not undercutting our prices too much so that we can keep a healthy margin in our business. And that's sort of an end-to-end type of story that we could realize through some examples and use cases here that I just mentioned. And I'll quickly just switch over and dive into these Tableau dashboards right now. Just give me a second. Okay, so that should be coming up on your screen. What you can see is our public Tableau site of Keras. You can go to this web address, or you could go to Tableau Public and just search for Keras specifically. And it'll take you to sort of this page where we have all these examples listed. There's a lot of retail and CPG examples, and also examples in finance and other industries that we work in. The landing page that you could click on will sort of give you a perspective on some of the things we work on in retail and CPG and grocery specific by business unit. So we work a lot with strategy teams to set up executive data strategy for organizations at high level, work with marketing teams to understand ROI, sales teams to do operational reporting, finance and supply chain, like I mentioned. And you could click on these links to take you to various dashboards that you can interact with. But let's start with a sort of high-level overview of the type of data that we're looking at here. This is our retail analytics, sort of just operational dashboard. It shows that if we're a big company, we sell across all. Kind of reloaded there. If we sell across all of these stores in the United States, it shows us essentially what's profitable, introduces some of the main KPIs that we use to look here. So for example, things like sales. Is our year-over-year sales increasing or decreasing? Is our number of units shipped increasing or decreasing? How many doors or accounts or stores are we actually selling it to? What's the velocity in these stores? And essentially, what is the price point? What's the average price per product that we're selling? Is it increasing or decreasing? These are very good tactical operational things that we could track. The executives are very interested in on sort of a weekly level. And it gives you a good overview of the health of the business. We could equally support demand planning processes, and this is especially nice in a tool like Tableau because of the built-in forecasting features. And forecasting becomes pretty critical in the demand planning process. You want to know essentially how much product or what's your revenue stream or what's your cost of goods going to look like forecasted into the future. And what you'll notice in a lot of CPG and retail businesses is, there's all these nuances of these peaks and valleys essentially throughout the seasonal selling cycles. And this is great because now you could see here, if you concentrate on sort of our forecast out for the next 18 months or so, that the models even built into Tableau, the forecasting time series models built into Tableau are picking up some of these nuances. And I can easily select, a particular store here on the dashboard and get a very granular sort of view of the forecast for that store or that product, and start to understand, not only what products are driving my sales, but essentially what's the peaks and valleys of a particular store or account type going to look at. So you can see that even in this sort of non-linear data where we have these peaks up towards the end of the year due to holiday times, the model's able to pick up these nuances very easily. And this is just right out of the box. And we see this as a sort of starting point and a foundational level of informing the demand planning process. So we need forecasts for the next 6, 12 months or whatever to make operational plans, to make business plans, to report back to shareholders. And we could do that quite easily and drill down and have very granular forecasts for products and accounts just on top of the data that we already have here. So we could service that out to finance or other departments that needs to use this data to formulate the rest of the demand planning process. Okay, so then, if our demand and our forecasting looks good, then we're really interested in maintaining the health of our supply chain. And of course, this is an area that's received a lot of attention in the last few months, obviously, because of the COVID situation. And we like to do modeling on top of the digital supply chain. And what we see essentially, if we could bring in all of this data, and I forgot to mention actually in the beginning, sometimes getting all of that operational data into one place is not exactly as easy as it sounds, right? To get sales, to get costs, to get financial plans in there, to get syndicated third-party data in there, it's not as easy as it sounds. And as Curious, we work a lot on the data engineering side to make sure that we're delivering high-quality, clean data into our front-end application so we could do this type of reporting and analysis. But one of the things we like to do is bring in data from our distributors, if we could get it in real time so that we can understand exactly the health of our supply chain should something happen. And typically what we see is that the supply chain of a particular company, let's say we're selling like appliances, electronics, tools, and these types of things here. What we could see is that the supply chain is really driven from distributors that are ranked into tiers. Okay, 1 second. Sorry about that. So these tiers, distribution companies, they exist in tiers because we negotiate, we have discussions with, and we form relationships with companies at various levels. And basically, like the more you buy, the better price point and deal levels that you can access. So what we like to do is sort of understand the impact to disruptions on this type of supply chain. So let's say a majority of our products or part of our supply chain just got completely disrupted because of COVID. And our tier A suppliers are now saying, you know what, we have a supply distribution issue. Maybe some of their raw materials came from China or from other parts of the world. Supply chain's been disrupted. And they say we can only service probably, like 65% of what we were giving you before. So I can use that slider here, which is tied to a model underneath, to sort of estimate what's going to be the impact on things like my orders. My demand is probably still high. If I'm in grocery especially, we know grocery stores, like, they were impacted by COVID, that's true. But some categories probably saw an improvement. We know that, people were hoarding like various categories and products. So overall, I think, the grocery stores, if anything, saw probably a bump in the initial stages of the lockdown period. So they still had the same demand, but the distribution network got all messed up. So what can they do? They have to source materials from other distributors. They have to source products from other distributors and other places where maybe they didn't have such good pre-existing relationships with. So there's going to be an inferred sort of price point or a price penalty that we're going to have to incur here. So if my tier A distributors just said, we don't have it, we can't fulfill all of your orders, but I still have the same demand. I'm looking at something like a orders gap of, like, say here, like 1.7 million orders or a delta of 1.7 million orders. My months on hand is sort of dropping below my preferred threshold of 3.5. Notably, my cost impact, my cost of goods purchased went down, like sure, because I can't purchase as much. So my cost of good is down. But I really want to try to make up this order and understand if it's going to have an associated cost impact and what that cost impact is going to be. And I can do this if the data is tied together the right way underneath the hood. And especially if my manager is asking me for this number, what's the expected cost impact? For example, if we order a lot more from our tier B distributors, right? Can we start making up this gap in our orders? Yes, and we could start closing the gap. And if we add a little bit from tier C as well, we could sort of see that, yeah, we can make up sort of the delta in the orders. There is enough supply in the market available to make up the orders. Our tier B distributors then become our sort of primary source of raw goods, materials, and products. Our months on hand sort of goes back to kind of like, we like to keep it at 3.5 for various categories. But then the associated cost impact is we don't have the same relationships with some of these distribution companies grows. And maybe that cost impact is upwards of 9 to 10%. So imagine having that conversation with your manager and trying to figure out, how are we going to sort of negotiate the same deal levels and price points with our tier B and tier C distributors, especially if, this is going to be a near to midterm sort of situation where because of the lockdown, this is going to exist for a while. So we like to understand these and use this as a starting point for discussions to be had with sort of tier B, and maybe we're looking to lock in sort of longer term agreements to mitigate some of the cost impact. But it's very important to understand what that cost impact is to start with. I'm going to move to sort of the retail side of things now, but let's say we negotiated price points. We got our stores stocked and shelved. A few disruptions, yes, few things changed, but basically we have products to sell. We have demand. So now we just want to make sure that we're selling at the right price points so as not to impact our margins too heavily. So how can we, sort of take a look at this, and what are we really trying to say and optimize here? When we put all the data together underneath the hood, and this is like, sometimes a bulk of the work, 80 to 90% of the work is putting data together to facilitate this type of reporting. We take our revenues and put it alongside our cost of goods, which is not always a very clear and easy process to do. If we could take all of our promotions and sort of campaigns and advertisements and everything that we're running to promote products and tie that together alongside our revenue and our cost of goods, especially to get an idea of what price points we're selling at, we could effectively get to a granular level or a view of what our profit margin truly is. And profit here, we mean to be like, your revenue minus your cost of goods is kind of very clear. But once you add your expenses on top of that, especially your investments into promotions and campaigns and different activities, once you add your investments and your expenses and your promotions on top of that, you sort of get to like a net profit picture or a contribution margin, essentially. It's essentially like your net sales minus your variable costs. And what we're really trying to optimize and maintain here, sort of a traditional view on what a price curve looks like. This is like economics 101. If I have, a price that's increasing along the x-axis here, I'm not expected to sell as much because people are not going to buy at higher price points in fair market conditions, right? So I'm getting these price curves out at the point of sale for various categories and products. Here we're looking at beer, for example. So, part of the modeling is fitting this curve, which is, pretty clear cut and dry and easy. But the other part of it is putting the data together to understand what the impact is on your profit. So a few things can happen. So if you sell too high of a price point, then your volumes are not going to be there, and you're not going to make enough revenue to sort of offset your expenses and your investments. But if you sell too low of a price point, then yes, you're putting, you're pushing essentially more volume out the door, maybe even getting more revenue out of it, but your expenses are going to increase because you're eating up too much of your margin. You're investing too much into promotions. So there's a inflection point somewhere along this curve that makes your profit essentially look like like a normal distribution here. And you kind of want to sell at the price point where your profit is going to be maximum. That's how we kind of think about optimizing these things. So that's really the heart of, on the retail side, we kind of want to push things out at the right price point. And to understand what we mean about sort of tuning and optimizing promotions, we have this other dashboard, which is like a promotional spend analysis. And we did this with like yogurts with one of our companies. So imagine I'm a yogurt company, and for example, like Dannon, I'm selling things, that's for sure. That's the chart on the left, sort of doing well on the sales side. But the chart on the right shows that, you know what, some of our retail stores, some of our accounts like make profit and some don't. So why are some of our accounts, non-profitable essentially from a contribution margin point of view? And to do that, we had to kind of put all the data together underneath the hood again to sort of understand what our revenue minus our costs, minus our spends on these promotional activities would look like to essentially calculate out a total profit. And we set up this dashboard in the sort of A versus B type of scenario so that we could play around with some sliders on the right-hand side to see if we could do a little bit of what-if analysis and inform strategically to try to understand, to see where we're losing margin. So like I mentioned before, some of the promotional things we do spend, and invest in heavily, things like EDLP. EDLP is a big one. Sustaining like an everyday low price and, a big grocery store is kind of a costly endeavor for a lot of vendors and manufacturers, especially, for the retail side, they may be contributing to that as well. So it's a big investment, and this is essentially like, at the heart of the price war. There's other things we spend money on: events, PR, sampling events. Like you could try products out in stores. These are relatively smaller spends, as you can see on the scale. But then there's things like feature and displays, sort of scan and promotional reductions that you do at the counter, things that are on sale essentially. And these two, like EDLP and sort of sales that you do, more tactical sales, sort of dominate the landscape if you look at it in context of the other sort of activities that you can do. Let's take a look at what we're talking about here. So for example, if I take a look at Kroger, which is already selected, see my revenue is down a little bit this period. I think we're looking at 6-month periods here, year over year. My cost of goods is down as well. I didn't sell so much. I didn't spend as much in promotions as I did, but my profits are like tanking too. So the question in the game becomes, can we sort of adjust the way we invest in these activities, in these promotional activities, to make Kroger profitable, to make ourselves profitable? Can we do that? And essentially the answer is like, yeah. So, we tied this all together underneath the hood with a model to facilitate this type of what if and planning analysis. So for example, if I start to take money out of EDLP, I'm clicking the slider here, just give the dashboard a second to reload. That has to initialize. As I start to take money out of EDLP, okay, I'm moving that slider back. We can see that we're starting to claw back some profit margin, right? This is a good thing. Like I'm starting to claw back my profit, basically because my spends have been going way down. I'm sucking promotions out. But that's having an adverse effect on my revenue. And that's what the model ties together. Essentially models revenue as a function of all your spends here. This is tied underneath the hood with a model that we came up with in Ultra. It's a very simple linear model because that's all we could support on Tableau Public. But this is where we would bring in like machine learning, a neural network, something that could give us, linear model does fairly well here, I have to say. Like it's relatively okay. You could see these sort of predictive versus actual values in the plot above. Really, I'd want all those points to be along that diagonal line. And something like a more advanced machine learning model could certainly capture some of the nonlinear nuances that are in the data to give us more accurate results. But this linear model does okay, that's fine. But what it really allows me to do is understand this impact. I can't just move this slider around without impacting my revenue because they're tied together. If it was just a slider on a dashboard, then I wouldn't know how my revenue, changes as I sort of move my on my investments up and down. But I did take a little bit out of EDLP. Let's take a little bit more, make it like a 30% drop. And all of a sudden you could see like, wow, you recovered, yeah, your profits, your net profit, because yeah, like basically because I tanked my spends, my expenses like went way down, but so did my revenues. And that's not necessarily what I want. I want to maintain revenues while being profitable compared to last year. So what we could do is take some of that money, invest a little bit more in something a little bit more tactical, like this, some price reductions here. And what we could see is we start to claw back, some of our lost revenues. Our profits like go down, but are still positive, because our spend margin is sort of decreasing a little bit. I can ramp this up essentially a little bit more, see what happens to my profit. Okay, that's not too bad. I'm about 2% up. Revenues are still 20% down. Maybe I can invest a little bit more in some features and displays, pump those up a little bit. And essentially what I could see is that I can start to claw back some of my lost profits while maintaining, relatively appreciable revenue margins. And if I take my features up a little bit more, I could sort of get to a point where I'm kind of happy with the predicted sort of profit increase. I am profit positive now. This is what I want to see. I'm making profit compared to last year. My profit's growing. When my revenues, my revenue downturn is not that bad. And all I did was essentially shift a little bit of investment from EDLP into something a little bit more tactical. And we're not saying like completely go out of EDLP. It's still there. It's still a very prominent sort of investment channel. It's just, finding these inflection points and informing the planning process and the strategic discussions around where exactly should we and how exactly should we spend our money. And we could realize this if we have the data all together underneath the hood in the right way, pieced together. If we could build models, sometimes we build those models in tools like Alteryx, R, Python. It's great to use machine learning for these types of problems. It's really just complicated regression problems, because the machine learning algorithms pick up a lot of nonlinear nuances in the data. And we could realize and we can inform the planning process and facilitate these what-if analyses on dashboard like this. And it's very easy to do this in a tool like Tableau because it integrates so well with these models, and it provides a very nice and slick user interface. So we're sort of using the dashboard as a, as a substitute for building my own like web app, which would take me forever. But we could realize and put the data in here and drill through and, create these what-if analyses very quickly. So not only do we do, operational reporting, I think, that informs sort of strategically what's happening in our supply chain to our point of sales and particularly in grocery, but we could really inform and get to the prescriptive analyses that we want to sort of facilitate to make sure that not only are we understanding what's happening with our data, but what we understand the actionable insights that are coming out of our data from these prescriptive analyses. So those are some of the things that we can do with data. I'm going to go back to the slide deck and open up the floor to questions and answer period.
Raz, it does look like we have a question about data source challenges in this space and some of